Welcome back everyone, and in this video we're going to discuss and analyze a cheap and undervalued dividend paying company that may make a nice addition to your portfolio. As the market hits new all-time highs every single day, a lot of stocks on the market right now are extremely overvalued, and we see a ton of companies trading at record high valuations, and it really isn't worth getting into them at these current levels. So I found one cheap or undervalued company at this price point right now, even with the market at all-time highs, that has a lot of upside over the next few years. And the company we're going to analyze today is Merck. This is a big pharmaceutical company with a market cap of $200 billion that does have a lot of upside potential for some growth in 2021 and beyond. And a lot of financial analysts on the market right now share the similar opinion of I do about Merck and do believe it could surge over the next 12 months. And I started my position in Merck not too long ago, and this is another company that I plan to average in over the next few weeks during any short-term dips on the share price. And in this video today, we're going to discuss Merck as a whole. We're going to evaluate the company, go over some future growth projections and why they're expected to grow in 2021 and beyond, and overall discuss this company and why I have been buying in, take a look at the financials, some future growth numbers and expectations, evaluate the dividend and dividend growth, and just overall discuss Merck as a company, and I'll share with you my personal opinion on why I am buying this pharma giant. And right now with the market at record highs, it's very hard to find some nice stable dividend companies who are yielding 3+%. Of course, you can chase some higher yields, but that dividend is not sustainable. With a company like Merck, even during this uncertainty in the market right now with regarding the global pandemic, their sales have held up very strong, and this is still a business with a very safe and growing dividend year over year that comes in at around 3.2% at this current level. If you're new to the channel, I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and sell, and discussing any major market news and headlines. And of course, in today's video, we're going to discuss the big pharma company Merck, go over why this stock may be undervalued at this current price point, and why we think it's going to go up over the next few years. So please hit that like button and subscribe for those daily videos, and we'll jump right into this Merck stock analysis. So the company currently trades at around $80 per share and is actually in the red by over 11% on the 1-year chart. If we take a look at the past 5 years, the share price has grown 54%, and over the past 10 years, the company is up 122% overall. And they currently have a market cap at just over $204 billion in trade at a very low forward PE of only 13.5. So this is a value type company with a nice 3.2% dividend yield, and we're going to take a look at the dividend and the dividend growth later on in the video. And I am not alone with having an opinion that Merck is undervalued at this $80 level. And analysts from Citibank share a similar opinion with this latest report. They believe Merck is the most undervalued major global pharma giant at this point in time, and they believe the fact that Merck does not really highlight the drugs that are in the early stage of development has really led to the overall market undervaluing the drugs that Merck owns and that are early on in the developmental stage. He believes that the pipeline of drugs and products that Merck is developing right now can lead to immense earnings and revenue growth over the next few years down the road once they are available to the market. And he likes that Merck as a company as a whole is not really upplaying what they're developing and not overestimating the growth rates of these businesses just yet. And I think analysts are undervalued and underplaying what Merck can achieve down the road. And he rates this company as a buy with a price target of $105 per share. And that represents around a 31% potential upside from where we sit today. And one interesting point was that Merck was included in the top 10 best stocks for 2021, according to Barron's. So a lot of major analysts are actually bullish from Merck at this current level and see a ton of upside in the share price over the short term. Now, if we jump over to Simply Wall Street, they believe Merck stock is 44% undervalued at this current level. When the company trades around $81 per share, it represents around a 44% undervalued, and the estimated fair value from Simply Wall Street on Merck stock is $145. So if this is an accurate measure of the company, a significant downplay at this current level. And if we take a look at another analyst report, you can see over the next 12 months, they're predicting around 17% potential upside and the share price to hit around $96. and you can see it currently has a buy rating. 6 strong buys, 11 buys, and 5 holds. And over the past 6 quarters, Merck has done a terrific job of beating analyst expectations. We've seen 5 positive beats and 1 in line, but you can see when they have beaten analyst expectations, they've done it by over 10 or 20+% each and every time. And annual revenue is only expected to accelerate down the road. For 2020, we were only expecting close to 3% annual revenue growth, but you can see for 2021, we see a large uptick, and now we're expecting more than 10% annual growth from this large cap company. And CNN has a similar price target for this business as well. Their average analyst price target is at over $96 per share, which represents at least 19.8 or 20% upside from this current $81 level. And their analysts have 14 buys, 3 outperforms, and 5 holds overall. So you can see no one is selling out of Merck at this level. Both analyst reports have no one selling out of this big pharma company. And if we take a look at some of their key financial stats, you can see that they actually have nice financials. Profit margins are coming in at over 24%, which is great. They have return on assets of over 11% and beautiful return on equity at over 41% overall. And even during a pandemic-ridden year, year-over-year revenue growth slightly increased by only 1% over the latest quarter, but their bottom line and their net income grew 54% year over year, which is a great sign to see. And with regard to the balance sheet, their current ratio sits at 1.3, so they are not really worried about their short-term financial position. And another very interesting part about Merck that actually attracted me to do some research into the company about a month ago when I started my initial position was that Warren Buffett and Berkshire Hathaway are buying into this company. In December of 2020, he started a position in Merck and invested more than $2 billion into this big pharma company. So of course, Warren Buffett is known to be the greatest value investor of all time, and he did just that. He invested over $2 billion into Merck, and he believed that this pharma company is at a great valuation at their current level. And now we're going to discuss some reasons why Merck can continue to grow down the road. So one of Merck's largest drugs is Katruda. This is the largest drug for the company, and it accounts for around annually $15 billion of top-line revenue. So this is a major driver of the business, and Katruda is still posting some massive growth rates. It generated more than 20% annual growth over the latest quarter on a year-over-year basis. And as a whole, this market is only expected to grow, and Katruda could be an over $24 billion per year drug during the mid-2020s. So the fact that this drug right now is already a major part of Merck's total revenue, bringing in annually around $15 billion, analysts are predicting that over the next few years, it can grow and generate more than $24 billion of top-line revenue each and every year. And this is not the only drug in the business. Some of their other smaller drugs have seen massive growth rates in 2020 as well. 2 of their other drugs were up 58% and 29% respectively year over year. And of course, Merck is also diversified not in only human health. They are also operating and create different drugs for animals. And their animal revenue stream grew 12% over the latest year. So you can see as a whole, this company has growing revenue, and a lot of their business segments are actually accelerating over the past few years. Their drugs are taking off for humans, and even their animal segment are growing at a very nice rate. And overall, Merck has a solid outlook down the road, and there are a ton of drugs in the pipeline that aren't on the market just yet that do have some strong potential. We're expecting revenue growth of more than 10% over the next 3 years, and the long-term earnings per share forecasted growth of 8% per year sounds very promising. So of course, this is not what tech companies do, but of course, this company is trading nowhere near the valuation of major tech firms. And of course, when Berkshire and Warren Buffett like a company, there are many good reasons at why they do that. They are some of the best investors in the world, and they don't just willy-nilly buy different companies. They know everything about this business before they buy in. They know the future potential, and Warren Buffett does not buy into businesses that he does not plan to hold long term. So if he thought Merck was a short-term player only, then there's no way he would have bought in. The fact that he bought into 4 big pharma stocks, he really must like that sector. They pay nice dividends, and a $2 billion investment, even for one of the largest players in the world like Buffett, is still a significant amount of money. And now we're going to move over into Merck's investor presentation. So there's only one slide I'm going to focus on today, and this is where they show their capital allocation. So with every business in the world, strong management has to decide how to use the capital, how to use the net income to allocate into the business in order to grow it as a whole and return investors with either capital or a dividend payment. And I really like how Merck is planning to spend their capital over the next 3 years. So you can see their capital investment plan from 2019 to 2023 involves around $20 billion over that 5 years invested into expanding manufacturing and technology and the capacity for their different vaccines and animal health products. So I'm a big fan that they're going to expand with that amount of capital. And they're also very balanced where they're spending around $9 billion invested into research and development, $6.3 billion spent on business development as a whole, and that includes a vaccine for the global pandemic we're going through right now, and around $8.3 billion in dividend and share repurchases. And their dividend actually grew by 11% in 2020, and they plan to do $2.3 billion in share repurchases over the trailing 12 months. So that's a great sign to see. With a company like Merck, a value play, a very strong blue chip name, I like companies who have strong management who allocate their capital in the right manner, and I believe Merck is doing just that. They maintain a very sustainable payout ratio of the dividend. They return capital to investors as a dividend and through share buybacks, and you can see as of late, the dividend growth has only accelerated. For many years, they only grew their dividend at a very minimal 2% per year to match inflation, but in 2019, they grew it by 15%, and then in 2020, they grew their dividend by 11% annually. So you can see they actually accelerated their dividend growth over the past 2 years, which is a great sign. And now if we actually take a look at that dividend, right now it yields 3.2%. The payout ratio is only 43% of their net income, which is extremely sustainable. And we just saw that dividend growth chart. And if you average it out over the past 5 years, it is around 6.5% per year annual growth. And they still maintain the highest dividend safety score possible, which is absolutely incredible. And that's what really draw me to this type of business. I focus on my dividend safety, dividend growth, and dividend sustainability. I never chase high yield. And even in the marketplace right now, where it's very hard to find a dividend that yielded 3.5%, 4%, 5+%, all the companies who are really paying that out right now have more substantial risk involved in that investment. And I'm not willing to risk my capital going down over the long term or a dividend cut coming in the future just because it pays 1% to 2% higher at the current level. I like long-term sustainable companies who plan to grow their dividend year in and year out for decades down the road, and I can sleep well at night knowing that the dividend is safe and sustainable. And Simply Safe Dividends gives the company the highest rating possible at 99, so I have absolutely no worry and do not expect a dividend cut coming anytime soon from Merck. And now we're just going to take a quick look at Merck's current financial statements. So we start off with the income statement. You can see year over year, top line revenue growth has been growing. It hasn't been growing at a massive rate, but you can see each and every year consistently, this large blue chip company has been growing and expanding. And their growth rate has actually picked up over the past 3 years and now set at over $47 billion over the trailing 12 months. And if we take a look at their net income, a very profitable business as well. You can see year over year, the average net income has been growing. There are some fluctuations year over year, but over the long-term trend, we can see they now sit at over $11.5 billion of net income on the income statement. So nice 25% profit margins for this large business. And now if we take a quick look at the balance sheet, the company currently has cash and investments of over $7.3 billion, and total current assets for the business sit at over $26.5 billion. If we compare that to their total current liabilities of just over $20 billion, their short-term financial position is considered to be strong and not worried about any short-term debt payments hurting the business whatsoever. Now, if we take a look at the total perspective, they have around $90 billion of total assets, but a large chunk of that, $36 billion, is coming from goodwill and other intangibles. So in reality, these kind of inflate the total asset section on a balance sheet, and I'm not a big fan of including those when analyzing a company. But if we do keep them involved right now, they have around $90 billion of total assets compared to total liabilities of $60 billion. But now if we actually remove those intangibles and the goodwill, that means they have around $60 billion of total tangible assets and assets you could sell for a dollar figure. and that would mean that their total assets to total liabilities are kind of even 1-to-1. The company does have a lot of long-term debt coming in at over $26 billion, but nothing too worrying whatsoever. And I do like the fact that their tangible assets are 1-to-1 with their total long-term liabilities. Of course, this isn't the strongest financial position on the market, but in no way is this a weak place to be. And if we take a look at total equity on the business, it has been going in the wrong direction, which is the one red flag with regard to the balance sheet. I do like to see total equity growing over the long term, but that is the only really bad sign I can see from Merck at this current level. So overall, this is a nice company. Their balance sheet is strong for this current position and for the next few years. Of course, there is always room to improve, and they could work to reduce that long-term debt as time goes on. But of course, with interest rates at record low, it really isn't that big of a deal to carry a little bit more debt at this current point in time. So as a whole, Merck's done a nice job of growing. Top line revenue continues to accelerate year over year, even for this large cap company, and we're projecting around 10% annual revenue growth over the next 3 to 4 years down the road. So Merck is definitely an interesting company to take a look at. One of the major big pharma giants with an over $200 billion market cap, a nice sustainable and growing dividend that really doesn't get talked to too much. I believe the company is undervalued at this current level, and so do Citibank analysts, and so do Simply Wall Street, and many different analyst reports. The average expectation for this company is for it to expand over the next few years. They have a ton of new drugs in development, and as a whole, I think Merck may be a nice addition to your healthcare sector of your portfolio if you're looking for a nice dividend and cheap value play right now in the market. So I plan to add more to this company for my personal portfolio as well. So thank you for watching, and I will see you in tomorrow's video.